pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Welcome to our special meeting,
That's my husband's keys.
March 20th,
I stole
2025,
his car today.
Jefferson County Local Development Corporation, excuse me. We really just have one order of business to review the audit and the parish reports, et cetera. So we don't have on here privilege of the floor, but I don't think we have that either other than auditors. So I guess, Bowers, please take over.
Good morning, Lori Podge and Lindy Hill. We're your audit team for both the IDA and LDC. Lindy's going to go through the audit reports. We've already met with management and gone through everything and our management letter comments also. So, go ahead. Obviously, some things will be similar between the two, so I'll hit what I can on the LDC first, and we get into IDA hitting the different points and things like that. The first question, feel free to stop me as I go through, or we'll address them at the end as well. So jumping right into the LDC packet, the independent auditor's report starts on the first page, following the table of contents, and right on the top of that first page, it discloses our opinion. So overall, it does state that the financial statements present fairly in all material respects the financial position of JCLDC in accordance with accounting principles generally accepted in the United States of America, so an unmodified audit opinion. On the bottom page one, it discloses the responsibilities of management. They are responsible for the preparation and fair presentation of the financial statements. And then following on page 2, it discloses our responsibility as the auditor. So overall, our objective is to attain reasonable assurance that the financial statements are presented without material misstatement. It is not reasonable assurance is a high level of assurance, but it's not absolute assurance. And we also are required to report in accordance with government auditing standards, being as you are a local development corp. So at the end, we'll see a report in accordance with government auditing standards as well. The LDC report was issued, as you'll see, dated March 3rd. Before we get into the financials, you'll see the 2023 column. For the statements does say restated. That is in regards to reporting of an operating lease with the corresponding amounts as a right of use asset and operating lease, and there's disclosure on that in the footnotes that we'll go over in note 5. But just cleaning that up in terms of the corrected term on the lease and payment schedule. So jumping into the statement of financial position or your balance sheet on page 4, total assets down about 19% in the current year to $4.4 million. Overall, your cash did decrease about 20% to $3.8 million. Some outstanding receivables at year end as well. Overall, obviously, your loan portfolio coming down with collection. We'll see that in the footnotes as well. Outstanding liabilities, the unearned revenue, similar to that we'll see in the footnotes, is cash that you're holding that has not been spent for ARPA funds, declining as well. So overall, your current liabilities decreasing significantly, and overall total liabilities decreasing from about $2.4 million to $974,000. The difference in your assets and liabilities leaves you with your net assets, all without donor restriction, in total of about $3.4 million, which is up 12% from the previous year. Your statement of activities on page 5, the top section for your support and revenue increasing about 44% from the previous year for $2.5 million in total. We'll see details as well on the Jefferson County support, seeing the increase there from the prior year with overlap of contracts for the period of January through September with changes in fiscal year. Expenditures down about 11%, just under $2.2 million in total. And similar, we'll see the full detail of those on the next statement. So difference in your revenue expenses, leaving you with your change in net assets. Our income for the year of about $377,000.
Can I stop you for a minute?
Yep.
Why is 2023 restated?
So that is accounting standard discloses your leases. So with a lease, you have a right of use asset and then a lease liability. So those two numbers are updated to correct the lease term.
Okay.
Administrative fees, there was a large change in that, 300,000.
Yep, we'll see that in the disclosure too. So last year, you guys waived a portion of the admin fee between the IDA and the LDC. So accounting wise, that is written off for the period that you guys forgave between the two entities. The statement of functional expenses on page 6 required for nonprofits a full disclosure on all of your expenditures by natural classification and then allocated based on what your program services are, and then general and administrative, similar comparing the total to the previous year. Overall, about 79% of your expenses are relating to your program services and about 21% for general and administrative. In the current year, salaries and employee benefits decreasing about 8%. The other significant change, professional fees increasing in the current year with a new professional service contract you guys have with $50,000 in the current year expenses.
It's part of the administrative fee, that 700,000, it doesn't match up with the 447, so some of it's spread across agriculture and other things.
Right, so
On the prior page.
yeah, the administrative fee revenue is what you charge in between the two entities to
Okay.
cover salaries and everything like that. On the expenditure side, your general and administrative expenses, all of that is allocated. So everybody's time is allocated between
Mhm.
your programs, management, and general. So two different,
So this is
Yeah,
truing
not
up, this is
comparing
what
apples
it
to
actually
apples.
cost, but we've taken 713,000 out of the IDA against 447 cost, or is part of the 440, the 713 buried in the 206 to 348?
right, yes.
Okay,
713 covers wages and things which similar, you'll see it all split.
that's why I
Among
thought that
all
was the
items.
answer, I just wanted to make sure.
Statement of cash flow on page 7, so the financials presented on the accrual basis of accounting, so this kind of shows you the actual cash that's coming in and out. So the top, your change in net assets or income for the year, backing out non-cash items like depreciation expense, credit losses for write-off of loans, and then the change in your balance sheet items for changes in receivables and payables. So overall, in the current year, you had net cash used in operations of just over $1 million. As you can see right above that, really the majority of that is spending down that ARPA money that you had collected from the county and the other agency in the prior year. Cash flow from investing, one minor purchase of property and equipment for a video bar, collecting on your outstanding loans, so cash coming in of about $68,000. Overall, leaving you with a net decrease in cash for the year of $979,000. The notes to the statement's pretty standard with what you have seen prior years, so I'm just gonna hit the high notes. Note 2 summarizes all of your significant accounting policies. In the current year, there is no new accounting standards or policies that change anything with the reporting. So I'll highlight on page 12, there is a summary of the restatement of the assets there. So that was a verbal explanation again of why that 2023 column is showing as restated, and the impact of that to update the lease term and payment schedule. So adjusting the beginning net assets for the beginning of 2023 by about 28,000, and it reduced your expenses in the 2023 column by about 36. And similar, it's just amortization of that, whereas obviously you guys pay monthly rent, it's not changing anything in terms of cash flow. Note 3 on page 13 summarizes all the required disclosures for your loans receivable. So obviously loans are all current as of the end of 2024, being collected. On the top of page 14, you'll see the rolling of the allowance for credit losses. That allowance is reported based on the provision necessary for the COVID-19 emergency loan forgiveness, with a few of those being forgiven in the current year, reducing that outstanding allowance down to $35,000. With one loan written off in the current year for credit loss expense of just over $6,000. Note 5 summarizes the operating lease on page 16. So similar, this was one of the accounting standards that have changed in recent years. So you do have that right of use asset, operating lease liability. So there you'll see the future payment schedule under your lease obligations for the next 5 years and thereafter. With the present value calculation that's reduced down to show the total outstanding lease liability of about $220,000. Within note 6 on the top of page 17, there it talks about the administrative fee that you do charge between the IDA and the LDC. So right in there too, you'll see the explanation about $713,000 in the current year, and in the prior year, 5 months of those services were given as in kind, and the IDA did not reimburse the LDC $295,000 for that. Note 7 summarizes the unearned revenue. So this is cash you collected in advance. The majority of that now is the balance being the ARPA fund. So in the current year, you had about just under $2 million of cash. Used about $1.3 million of that in the current year, so leaving you about $640,000 in unearned revenue of those ARPA funds at the end of the year. Note 8 summarizes the Jefferson County support and the detail there on the different sources that they fund. And as previously mentioned, there was overlap in 2 contracts with your guys' change in fiscal year. So there's a duplication of the revenue source for the period of January through September, driving that increase in the current year. Overall, all the deposits are fully collateralized as noted within note 9. Note 10, your retirement plan, the LDC contributed about $45,000 to the plan in the current year. And then as previously mentioned, with the ARPA funds, note 11 provides some additional details on that as well. And noting there that you did recognize $1.1 million of grant revenue and grant expenses on the financials, and that leaves you with about $640,000 of remaining funds to be used and spent in future years for that. The last disclosure, note 12 on liquidity and availability of financial assets required for nonprofits, summarizing your available liquid assets and things that are not available for general expenditure due to restriction. So overall, you have about $3.3 million of financial assets available to meet general expenditure, so that with your budgeting, there's no going concern issues for the entity. Lastly, note 13, the subsequent event. You'll see that disclosed in both the intercompany loan approved by the board on February 6th for cash flow purposes with the airport sewer line project. In the current year, the LDC is required to have a single audit because you guys spent more than $750,000 of federal awards. So the last section of the report is in regards to the federal award program information. So the first is the independent auditor's report on internal control in accordance with government auditing standards. That report is not an opinion report, but overall it does disclose on the top of page 23 that we did not identify any deficiencies in internal control that are material weaknesses, and there was no instances of non-compliance in accordance with government auditing standards. The other report is the auditor's report in accordance with the uniform guidance for compliance requirements. With that single audit, again, clean report there that the compliance requirements were followed for the major federal programs that you tested. Similar, management is responsible for compliance with those requirements, and it's our objective to obtain reasonable assurance that you have complied with the uniform guidance. So on page 27, it summarizes your federal expenditures. Again, the use of the funds split between funds that were originally passed through from the IDA and then some from the county for a total spent of $1.13 million in the current year. So a clean single audit. Page 29 being the schedule of findings and question costs kind of summarizes in one page all the results from the financial statement audit and the single audit. So again, an unmodified opinion on the financials, no significant deficiencies, no instances of non-compliance material to the financials in accordance with government auditing standards, no significant deficiencies over the major federal award program, and an unmodified opinion on the major federal programs, being that you did just have one program. That was what we tested within the single audit. Last year, the LDC did have a couple findings with the single audit, so we're required to disclose that in the follow-up in the summary schedule of fire audit findings. So last year, there was a significant deficiency in instance of non-compliance reported for the LDC in regards to identification of subawards and then subrecipient monitoring, which the LDC has identified that agency and been monitoring them to ensure they are also in compliance with these federal regulations under the uniform guidance as well in the current year. And then so lastly, in the back of your packet, with the loose leaf letters, there is one that is a communication with the board letter that discloses estimates that affect your financials. that being the allowance, depreciation, and useful lives of capital assets, present value calculation on that right of use piece, asset and liability, and also the functional expense allocation, which is driven by time and effort analysis to allocate those related expenditures. Overall, we had no difficulties performing our audit. The material misstatements are attached to this letter for review, and all of those have been provided to management and corrected within the general ledger. The other loose leaf letter in the back is our management letter. So again, with the audit report and things, these are more of just internal control, housekeeping items. So the first is in regards to measurement of credit losses. We talked about this a lot last year. When you're required to adopt CECL, or the measurement of credit loss on financial instruments standard last year, it changes kind of the way that you look at and calculate the allowance over your loan portfolio. And under this new model, expected credit losses have to be measured based on not just historical experience, but current conditions, and other supportable forecasts, with future expectations as well. So it was noted that the lending policy was not updated in the current year, and the documentation over the allowance didn't have adequate documentation within compliance of the new standard. So recommendation on updating the lending policy, on how you will determine and calculate your allowance. And then same thing, using those other factors and future expectations and documenting that, so they are documented with supporting factors when they're provided to you guys for approval and then for us to audit. Another suggestion on the journal entry. So in the current year with the staff changes, there's really just the CFO recording journal entries. So same thing, the entries should be under dual control. So recommendation probably being that on a monthly basis with your reporting package, the journal entry report be provided and then be reviewed and approved by the CEO or treasurer within the board on a monthly basis for dual control.
With that, how much have you looked at that
And
on
what?
a monthly basis? The general journal entries, or do you?
I probably would say minimally. The actual journal entries? You mean the bills?
No. There'd be any specific entries made to the general journal itself,
General ledger, right?
general ledger.
I don't believe I see that, do I?
No, you don't.
Yeah, right.
Okay.
I guess I'll have to. Does that mean I get a raise?
Yeah, that would be great if you did, but I think that get a raise and look at it, of course.
I motion we double your salary.
Immediately.
Okay,
You can now pay us $5 instead of 10.
Okay.
You got a raise.
I don't look at them monthly, currently. So the plan being that I'm gonna start handling that piece.
Okay.
And I mean, it would be great to have some additional oversight from the treasurer, but just that's the plan as far as that goes.
No, that's fine. Sorry.
The next one with capitalization policy, so current policy is that you're capitalizing items over $1,000. So that requires tracking and depreciation expense of some minor equipment and office purchases. So recommendation that you look back at the policy and increase that threshold, such as $2,500 or even $5,000. We talked about with management for the future. The next, general ledger maintenance and financial reporting requirements. So a couple housekeeping items with the checking account reconciliation having unreconciled differences for the month of December. Those transactions were identified by management relating to automatic payroll transactions, but not documented or corrected for the bank reconciliation. There was also a material outstanding transfer between two organization accounts from July 2024 on the bank reconciliations, which caused material variances on both accounts on internal financial statements. Also, material adjustments were required in the current year for grant activity, so picking up things for accrual basis of accounting for grant receivable, payables, and the correlating income and expenditures related to cutoff issues. Journal entries were required to recognize other sources of revenue on the accrual basis, being the agreement with accounting to fund the consulting services that you guys had included here. And then on the top of the next page, also the time and effort allocations for the statement of functional expense purposes. That's kind of like a time and effort study that management does maintain. Obviously, there are significant changes in the employee base in the current year and the roles of staffing, and those were not updated, so we did with the audit process update and review those with management to reflect that on the statement of functional expenses that we saw within the packet this year. So recommendations, bank reconciliations obviously are being prepared monthly, but making sure any unreconciled difference is identified at the time of the reconciliation and corrected in the general ledger prior to finalizing, reviewing, and approving bank reconciliations. If there is outstanding items greater than 1 year, reviewing them, especially between intercompany and internal organization accounts, and corrected in the ledger. Grant activity, monitoring that for accrual basis, so somewhere it's not necessarily when the cash comes in and out, but when things are happening. So they are recorded appropriately year-end for cutoff. And then management also monitoring, updating the wage allocations and time and effort, overhead allocations for program and management and general services based on current employees and duties. Again, as I mentioned, we did update that, so it is reflected in the current year financial statements based on updates to time and effort allocation that was provided.
Marshall, a suggestion to what Dave was saying is all of the stuff being done monthly, you can review it, but possibly have the audit finance convene quarterly to review what the work was.
Sure.
And then this way it kind of gives quasi-board oversight rather than adding another thing in our packet,
Absolutely.
which is fine. I mean, the whole board can certainly comment on it, but I think the purpose of audit finance is exactly this.
Agreed.
And we want to update some procedures, because it's really not in the resolution, but if we're going to change some procedures, maybe get those to the level for the next board meeting, and if we want to make that go forward.
The last item that you'll see in both reports require to report in accordance with the state public authority law. You guys do not hold any investments, so we're just stating that in accordance with your investment policy, there's no compliance issues with that in accordance with the public authority law, as required for some Paris reporting as well. Any other questions or discussion items for the LDC?
The last page, material statements, did you cover that yet, or?
I can go through them if you would like me to.
Well, I don't like the term of statements, but I'm sure it's an accounting term that
It is
isn't
accounting
as
term,
bad
yeah.
sounding as it is.
It's not,
So-
yeah, it's
okay.
just the journal entries that were required.
Okay, so
Because
this
the
is
audit.
to do the journal entries again.
I don't know, one likes that wording, but that is standard wording for us.
This sounds like.
Yeah.
Not the best term.
Yeah, all those entries have been provided in
Okay,
this document.
so they're all-
this ledger and updated.
They're all corrected and everything. And it all equals zero, just like all accounting things.
Debits equal credits, correct?
Any questions from the board? I think I have to read a resolution which will accept this audit and then a whole bunch of other stuff, so we'll go through that, but anything else to add before? Find this resolution here, page 43 of our packet, annual meeting resolution, special meeting, Jefferson County Local Government Corporation, convened on March 1st, 2025 at 8 a.m. Resolution 03.20.205.01, annual meeting resolution of the Jefferson County Local Development Corporation, including acceptance of annual audit, participation in certain policy standards, procedures relating to the Public Authorities Accountability Act of 2005, as amended by Chapter 506 of the laws of 2009 of the state of New York, election of board of officers, appointing board committee positions, appointment of corporation staff, and related matters. There's quite a few whereas clauses here. I'll try to hit the high ones as well. So a lot of this is, we're including acceptance of the audit, Paris reports, ratification of mission statement, property disposition, investment and procurement policy, selection of officers, board committee positions, and appointment of staff. They're covered throughout this document. I don't know if I need to read any more in here. Is that good enough? Okay. I'll give the board a moment to read this lengthy document, which is not a surprise to anyone, but. And then I'll ask for a motion to accept it.
So moved.
First and a second, any other discussion? Was this a roll call? Peggy, yes, it was.
Dave,
Yes.
John,
Yes.
Rob,
Yes.
Rob, oh yeah, so
No,
Rob
yeah,
Aiken's not here. Ed is absent, Paul,
Yes.
Bill,
Yes.
Lisa,
Yes.
Charles,
Yes.
Rob Aiken's absent, and Greg,
Yes.
and Dawn.
Yes,
There's Dawn.
She looks like she accepted. Okay, the resolution carries. And is there anything you want to cover after the roll call vote? I mean, it's got all of our information in here, but we've already voted on the resolution, just to know if there's anything you wanted to point out. All the information's in here, plus it's on the webpage after we ratified it, or is it always there?
So now Marshall will certify the Paris
Okay.
reports that are due in 2 weeks.
All right, good. Yes, for adjournment. First?
Yes.
Second? All in favor, aye?
Aye.
Any opposed? We are adjourned and we move to our next meeting. And then we duplicate this for the other one, the other alphabet. Okay, so we call to order our Jefferson County Industrial Development Agency special meeting. Again, same two orders of business. And please, we'll turn it over to Ballard. Take care of it later. Turn it over to Ballard again through the audit report. And this one has the CFDC baked into it, right?
Correct, yeah. Yep, so for the IDA, these are, kind of a combination of the IDA, the LDC, and the FDC as well. So there are supplementary schedules that combine all that. So similar, I'll hit some of the highlights, we'll look at some of the specific just columns, for IDA as well when we get into the statements.
Before you start, so we started the ferry last year. Is that included in?
Noted.
Yeah.
It's noted in here. Okay. Thank you.
Probably a lot of transactions.
Wow. You still got a note.
I know.
Similar, your independent auditors report starting on page 1, a clean, unmodified opinion. Similar, your financial statements are presented in accordance with accounting principles generally accepted in the United States of America. Similar, the IDA this year did end up having a single audit, so there's reporting similar in accordance with government audit standards, and also single audit reports that we will look at in the back with the IDA reports issued dated March 10th. The beginning section, the IDA's management's discussion and analysis on pages 5 through 17. So here you'll see 2-year comparisons. If you read through those few pages, you really should have a good understanding of your organization and everything that went on in the current year, and some future economic factors as well. So I'll leave that for your reading. So we'll start on page 18. So these are the combined statements here of those entities that we just mentioned. So just hitting the highlights here. Overall, for your assets, cash decreasing about 25% in the current year to 4.9 million. Your restricted cash going down about 14% to just over 2 million. Capital assets increasing just under 1 million to 5.6 million in the current year, leaving you with total assets of just over 15 million, which is down about 6% from the previous year. Outstanding liabilities of about 2.5 million. In the short term, other long-term liabilities for the operating lease and long-term debt of about 350,000, leaving you with total liabilities of about 2.9 million, which is down about 22% from the previous year. Decrease there driven by the use of the ARPA funds, which are in that unearned revenue line item. So difference leaving you with your total net position of about 12 million, which is down 2% from the previous year. In total, out of that 2.5 million is unrestricted. The next is your statement of revenue, expenses, and change in net position. Similar revenue, expenses, and change in net position. So your revenues, operating revenues down about 5% to 886,000. Expenses for operations increasing about 5% to 1.6 million, leaving you with a net operating loss for the current year of $769,000. Non-operating revenue and expenditures relating to the grants and some other miscellaneous items. Positive net operating revenue of about $537,000. leaving you with a net change in net position for loss in the current year of $232,450. The next is your statement of cash flow, direct presentation here of the cash flow. Again, because the financials are on the accrual basis, so the top section being your operating activities, you'll see the cash flows coming in and cash payments going out. So overall net cash used in operating activities are about $787,000 this year. Cash flow from non-capital financing activities, the grants received being DASNY funds for the airport project, grants paid out of ARPA money. So overall, you had net cash used in non-capital financing activities of just over $1 million. Additions to capital assets, similar relating to the airport park, the other additions in accounts payable, so the cash had not gone out at year end. In the current year, about $183,000, and then collection of cash for interest for investing activities on loan portfolios, leaving you with a net decrease in cash for the year, just under $2 million. The following page kind of summarizes that and how it ties back to your financial statements, and the reconciliation there from your net operating income or loss for the year of $769,000 and similar on the LDC, taking out those non-cash items for depreciation, credit loss expense, and changing your receivables and payable type items, reconciling back with the use of cash in your operations of $787,000 for the year. The footnotes to the financials, similar, comparable with what you have seen in prior years. You will see on page 22 about the reporting entity. It does disclose there the Area Redevelopment Corp, and that those are combined in with these financial statements, similar as the LDC and the FDCR as well, as blended component units. And then on the top of page 23, it does disclose there how you created that new entity. In 2024, there's no financial activity to date, so in the supplementary schedules, it does not have its own column, being that there's no activity yet financially for that. No other changes in accounting policies and things in the current year, so I'll jump to page 29. There starts note 3, in note on your loans receivable. Looking at just the restricted portion for the IDA loans for the outstanding balances by your loan programs. And you'll see further detail of those on page 31 with the outstanding loan balances for your revolving loan fund and the allowance against that specific portfolio, $570,000. On page 32, the breakdown of your micro enterprise loan program, similar an allowance for credit loss on those outstanding loans of $35,000 in the city loan program with a new loan issue during 2024 with no allowance reported against that, as that's deemed fully collectible. Page 33, you'll see the roll forward of those allowance numbers. So in the current year, the revolving loan fund, the provision to increase that was $380,000. So again, that $380 is flowing through the P&L as an expenditure for the IDA. Note 3 on page 34 is the breakdown of your outstanding loans based on the aging of the receivables, so a portion in 60 to 90 and greater than 90 days for presentation in there as well. Note 4 summarizes any of your grant activities. So for the IDA, you do have an outstanding grant receivable of $500,000 relating to the Watertown Airport Park, being the federal grant funds from the Northern Florida Regional Commission. Note 5 on the top of page 35 summarizes the outstanding balance between the total of the entities for unearned revenue. Of that, about $1.6 million of COVID-19 ARPA funds outstanding at the end of the year presented in unearned revenue. Note 7 on page 36 summarizes your loan activities. So counting there, the third paragraph in regards to the park at the airport, construction and progress costs are $1.3 million. As of December 31st, 2024, and at December 31st, the total cost of that property is about $2.3 million at a value of about $22,579 per acre. Note 8 summarizes your capital assets. So there you'll see the work in progress in the top section with increases in the current year. So leaving you with total work in progress of about $1.6 million. 1.3 of that is relating to the airport park and $300,000 to the intersection project that will be completed in future years. Note 9 discloses information on your pilot program, so there are minor Outstanding receivables at year end of $505, outstanding payables to other jurisdictions of $5,783 at year end. Note 10, the long-term debt that has been same as presented as in prior years with the loan due to the DOT and the future payment schedule showing that payment due in thereafter years beyond the 5-year period. I'll jump to note 13 on the bottom of page 40. So this is information on the business complex project at the airport. So overall, the project budget has been modified, so it's just over $2 million for the year ended December 31st, 2024. You've recognized $500,000 of grant income for the first and final reimbursement submitted to Northern Border for expenditures that were incurred in 2024, and that is federal funds, which is what drove you guys into having to have a single audit for the IDA. I'll also note on page 41 within note 14, commitments and contingencies, there is a disclosure there that you have one outstanding loan commitment of $250,000 that is not completed as of year end. And then on page 43, the subsequent events, so similar as we saw within the LDC, there is disclosure on the interfund cash flow loan that you guys approved on February 6th, and also notification there of the agency filing a complaint in Supreme Court in regards to the outstanding loan in default. So page.
You said outstanding loan. I thought we had 2 loans that were in default in 2024.
Do you mean Sackett's Harbor's piece and our piece?
No,
I'm talking
there's
about,
2 properties that are in default, but only one's been filed in court.
Okay.
Right, yeah, that note disclosure is just for the one with the court filing.
okay,
But yeah, on the aging schedule, you'll see that there was 2
But there are 2
loans.
pieces, it's $1 million, right, 850 and 150? I forgot how it got to $1 million, but it's 850 and then there's like another 150, wasn't there?
Well,
I can't recall.
I'm sorry.
That's the same, it's LDC's.
Okay,
okay, yeah.
I knew there was like some other.
Sackett's
genuine
Harbor
piece.
LDC is in
Okay,
there.
so that didn't come to us, I guess the notion's $1.3 million to somebody.
Pages 44 to 49 are those combining schedules, as we kind of mentioned with the IDA and those component units. So starting on page 44, just highlighting a couple of the main things specific to the column for just the IDA itself. So looking at the statement of net position or the balance sheet, just noting there for the IDA column, you'll see the bottom section for net position. The balance in the unrestricted is in a deficit of about $904,000 as of the year end. Overall, your assets were comparable to prior year. Increasing in liabilities is what's driving that deficit at year end. The next page on page 45, the revenue expenditures and change in net position, similar just within that IDA column as well. You had net operating loss for the year of just over $1 million. Non-operating grant income exceeding grant expenses of about $500,000 because those other costs of that were capitalized. Leaving you with a total change in net position or loss of about $619,000 for the year. The next set is those LDC, FDC components. The FDC, just highlighting there, they do have positive net position of just under $31,000 at the end of the year, and have positive change in that net position of $1,740 for the current year. And the last 2 on page 48 and 49, that gives you the breakdown of the IDA based on your programs, your general, and then your revolving loan, micro enterprise and city loan programs. Your general operations have total current assets of about $1.6 million, total current liabilities of $1.8 million, long-term debt of $880,000. So again, those current assets exceeding your current liabilities, that's what's driving down that deficit. In the unrestricted net position of $903,000. And then on page 49, you'll see the correlating revenues and expenditures relating to those separated by the programs. So similar change in that position, a loss in the current year in the general operations column of about $229,000. The last section is the single audit reporting for the federal program. So similar, originally, we thought the IDA would not have to have a single audit getting into the testing and things with the airport project. There's federal funds there. that are gonna be submitted for based on the expenditures that you did incur in 2024, driving you over the threshold of 750,000. So we did have to have a single audit for the IDA. So these reports are on that, the first being in accordance with government auditing standards. Similar as we saw on LDC, it's not an opinion report, but the report on page 52 does disclose that we identified certain deficiencies in internal control, identified as item 2024-01 that we'll see in the schedule of finding and question costs. And similar, an instance of non-compliance reporting to be required under government auditing standards. And we'll see those in the schedule of findings and question costs as well. The independent audit report in accordance with uniform guidance. Overall, that does state that the IDA has complied with all the requirements of each of the major federal award programs. On the top of page 55, the other matters there in accordance with the uniform guidance does disclose that an instance of non-compliance was required to be reported in accordance with the uniform guidance, similar in the schedule of findings and question costs that we will go over. So on page 57, you'll see the actual schedule of expenditures of federal awards with JCIDA. So you had about 292,000 of ARPA funds that were spent out of the IDA in the current year, and 500,000 of the Northern Border Regional Development Grant Fund. So in total, they're just pushing you over that $750,000 threshold, requiring a single audit. And we did have to test both of those programs for the single audit in the current year. So similar as on the LDC, your schedule of findings and question costs on page 59 that summarizes the opinions and things on all of our reports. So similar as an unmodified, please opinion on your financial statements, but we do have some findings that we're required to report for the single audit. So a significant deficiency and instance of non-compliance with that, and also one significant deficiency reporting under the financial statements themselves. Which we'll go over first, which is the finding 2024-01 on page 60. So this is in regards to the financial statements themselves with project management, the financial reporting, and general ledger maintenance of that for the accrual basis. So obviously you guys have the business complex project going on that we've been talking about, a lot of things with that affecting the financials this year. So it's been ongoing for multiple years and has multiple funding sources, federal, state, and local. The project is in construction phase, so there was material payables for contractors and engineers that were not properly recorded that were picked up with audit entry. The grant reimbursement request had not been prepared as of year end. Material amounts of current year expenditures were incurred that we're going to be submitting to these federal and state grantors for reimbursement. So under the accrual basis accounting, which the financials have to be presented on, requires recognition of those grants receivable and revenue. Similar payable and expenditures. Again, so that is what drove you guys into having to have the single audit for the IDA, picking up the additional $500,000 of federal grant revenue relating to that project. So overall, just the oversight on the project wasn't properly monitored to make sure that those grant reimbursements and requests were prepared timely and recorded in accordance with the accrual basis of accounting or identifying those federal awards prior to the audit. So just making sure for recommendation that procedures are implemented to improve the overall project management. So there's timely recognition and monitoring of contractor work and expenditures, and then what grant submissions will be submitted to cover those project expenditures. Any of these items do have responses from management and a corrective action plan, which are here in the report as well for disclosure. Another response to that is on the top of page 61. The next set of findings in regards to the single audit. So these really are the same findings that we had last year within the LDC. Similar with subrecipient monitoring and identifying the subrecipients with some of the ARPA money that you guys are passing along. So the significant deficiency for the U.S. Department of Treasury program 2024-02 discloses that the agency didn't identify a subrecipient of the coronavirus state and local fiscal recovery funds and apply the requirements as a sub-award made to that organization. So because of that and not identifying them, you weren't ensuring that they were complying with those similar federal statutes or regulations that you guys have to follow as well. So that is a significant deficiency, identifying them as being the sub-award, and then the instance of non-compliance is actually monitoring them as a subrecipient in the finding of 2024-03, so similar. Since you weren't able to have identified them as a subrecipient, you were not properly monitoring that as a subrecipient to provide assurance that they were administering the compliance in accordance with the uniform guidance as well. So that's them giving you a copy of their financial reporting in a single audit if they did have expenditures over the $750,000, just like you guys have to have.
Want to understand what you're telling us a little bit better. So with the ARPA funds, that's one of the examples you're citing.
Yep.
What was it we didn't do? Put it in common terms, please, so I can understand it.
Basically telling the people, the entity that you guys gave funds to, that it's federal dollars and they're required to follow the uniform guidance standards because it is federal funds. So they have to report it on their reports and things, similar to you would as a federal expenditure. So similar, if they had other federal funding sources, they were over $750,000, they would be required to have a single audit and financial statement audit as well.
So, for example, with the agricultural grants, if we awarded a $10,000 grant to a farm to purchase equipment, what should we have done to be in compliance?
Right, so those are not, they are not a subrecipient, they're
I'm
an
asking
end
about-
user of the grant funds, so that's not what the finding is in regards to. There's one specific entity that you gave the funds to out of the IDA that is a subrecipient, and similar last year with the LDC, one recipient that is not an end user, so similar, they got the money and then we're passing it on to someone else outside of their organization, so they were not an end user of the grant funds.
Okay.
And who were those subrecipients, or do you recall?
The town of Hounsfield
Okay.
is the
Right.
subrecipient that we're talking about here for the IDA.
Okay.
So,
And last year was the
CAPC.
But that was LDC, I believe.
Right, that right, was LDC, yeah.
This is the only one we have an IDA.
This
But-
has to do with the sewer project or
Yeah.
something else. Yeah.
so the smaller grants then we were fine on. It's the two larger grants where we were passing a larger amount of funds through that they were then going to award or use in some other fashion. Those are the ones that you're noting in your report.
And just to take a step further, so the uniform guidance are compliance steps that are designated that we have to follow. So there's no, subjectivity. So there's subrecipient monitoring is one of the steps that we have to do, and to make sure that you're following that. So they're very straightforward. It's not like a subjective of a management letter and things like that. So if it's at a level that it's material, then it will fall into the reports.
Thank you.
Any other questions on the
Not yet.
findings, financial findings so far? So I'll jump into the management letter for the IDA, so similar, the beginning of that is written a little bit differently because it does disclose that we identified those significant deficiency items that we just talked about, but similar to the housekeeping items. The comments here in this letter are the same comments that we just talked about for the LDC for things with your credit loss policy and documenting that for your allowance, the journal entries, same thing, ensuring that they are under no control. The capitalization policy, you guys can update that for both entities to higher level. And then the last comment on the bank reconciliations, similar type item that on the general checking bank reconciliation for IDA having unreconciled differences. These transactions were identified in relating to two pilot payments. And then it's also noted that there's material outstanding transfers between two IDA agency accounts on the bank reconciliation for internal financial statement items. And there's the reconciled cash balances that were designated for programs such as pilots or the specific loan programs were not in agreement with the ending that position based on what we saw in those supplementary schedules. For current year receipts and disbursements, so some of those transactions may be deposited or paid out of the incorrect accounts or adjusted with entries incorrectly in the journal entry or general ledger, So again, this recommendation of making sure those bank reconciliation items are identified at the time that they're completed and signed off on a monthly basis, and then the designated bank accounts, reconciling those back to the supporting information for cash flows in and out, making sure things are in the correct bank accounts. The other letter similar is the communication with the board, so that discloses similar to estimates affecting your financials. We didn't have any difficulties performing the audit or with management, similar to any of the material misstatements. Or journal entries are attached to that letter for reference as well. They've all been provided to management and posted and recorded within your general ledger internally as well. And then lastly, similar to report for the public authority law, similar to your investments, you don't hold investments, but your investment policy is in accordance with requirements under the public authority law. So reporting on that with those requirements as well.
Any other questions? All right, thank you. I'll read the resolution and then we repeat this again in the next meeting. So annual meeting resolution, special meeting of the Jefferson County Industrial Development Agency was convened on March 20th, 2025 at 8:15 a.m. Resolution number 03.20.2025.01, annual meeting resolution of the Jefferson County Industrial Development Agency, the agency including acceptance of annual audit, ratification of certain policy standards, procedures relating to the Public Authorities Accountability Act of 2005 as amended by Chapter 506 of the laws of 2009 in the state of New York, election of board of officers, appoint board committee positions, appointment of agency staff and related matters, and probably best summarized agenda. This resolution accepts the audit, parish reports, ratification of mission statement, property disposition, investment and procurement policies, election of officers, board committee positions, and appointment of staff. So I have a motion to accept the resolution. Bill?
Second.
John, any other discussion, questions? Roll call?
Dave,
Yes.
John,
Yes.
Rob,
Yes.
Ed is absent, Paul,
Yes.
Bill,
Yes.
Lisa.
Yes.
It carries. Motion to adjourn.
So moved.
Paul and John, you guys can put whatever order you wish. All in favor, aye.
Aye.
Any opposed? Okay. We'll move to.
Thank you.
Yes, thank
Thank
you.
you.
We'll move to our last hearing. Which is really one order of business. Order, the resolution is on page 3. Special meeting of the Jefferson County Civic Facility Development Corporation was convened on March 20th, 2025. Following the resolution is duly offered and seconded with resolution 3.20.2025.01, annual meeting resolutions of the Jefferson County Civic Facility Development Corporation, including acceptance of annual audit, ratification of certain policies, standards and procedures relating to the Public Authorities Accountability Act of 2005, as amended by Chapter 506 of the laws of 2009 of the state of New York, election of board officers, appointing board committee positions, appointment of corporation staff, and related matters. And again, it's best summarized in our agenda. The resolution, if passed, will accept the audit, which was the JCIDA audit that this agency is part of. Parish reports, ratification of mission statement, property disposition, investment and procurement policies, elections of officers and board committee positions, and appointment of staff. Motion to accept this resolution. Paul?
Second.
Bill. Any other questions or discussions? Probably a roll call, I'm guessing. Yes.
Dave,
Yes.
John,
Yes.
Rob,
Yes.
Ed is absent, Paul,
Yes.
Bill,
Yes.
Lisa.
Yes.
And we passed this one. And-
Motion to adjourn.
And a
Second.
second. We have probably 3. So, all in favor, aye.
Aye.
Any opposed? We stand adjourned.
Quick
Thank you
question.
so much for your time.
So you told me the other day you